So, Brandon, why don't you tell me a little bit about the case you've been working on right now?
Yeah, well, Vince, it's pretty crazy. This client came to me about 9 months ago and said they were going to be inheriting a pretty large estate. And I was like, okay, that's obviously nice. You're going to inherit that. Sorry to hear you're going to be losing a family member, but tell me a bit more about the situation. And so they kind of walked me through and eventually got me statements of the holdings of the family member that's going to be passing away, unfortunately on their deathbed. And the portfolio, first of all, it looked like a retail portfolio in that they were charging retail pricing, no tax deductibility. There was a ton of issues. And when I pointed some of these things out to the client, we ended up making moves on the portfolio sooner, prior to death.
So what happened if you don't move it, if you're too late?
So in this situation, like if we did nothing, my client would have ended up with about 20% less, because there was really no estate planning done. There was no trust planning done. Most of the assets were going to fall through probate, which is a 1.4% tax on everything, as opposed to perhaps looking at an estate freeze and deferring some of the capital gains tax to NextGen, my client's family. It seemed like the advisor from previous gen had pretty much set the accounts up and had just set it and forget it, and hadn't actually reviewed them in quite a long time. And I find that this is increasingly common among advisors that perhaps have been around for a little while and maybe are close to retirement. They're perhaps not as on top of things as they should be. So I'm really lucky that the client reached out in advance, because we were able to get some of this planning done underway, as opposed to if it was during the probate process, there's really nothing we could have done.
So how much they probably saved by going through all of the processes?
Between probate and then tax deferral, we're in the millions of dollars.
That's good, yeah. A lot of people think 1.4%, so that's not too bad, but when you factor in how much the total amount is, it's something.
Well, and the thing is, some people don't care. If someone's built up a large net worth and they've worked hard for it, they may feel that, well, the next gen can worry about this. Why should I worry about it? But I think next gen can do a lot of the heavy lifting and a lot of the planning work, and then simply just present options to the next gen. And that can ultimately mean more money for family, more money for charity, and less money for the government. And so if you had to choose between the three, who would you want your money to go to? Family, charity, or government?
Easy questions.
I think an important part of what this case has taught me is, if you can get the next gen advisors involved prior to death, they can have a much better understanding of what assets are coming over, and then end up helping set up the right structures in terms of investment accounts, in terms of legal arrangements. And maybe it makes sense to add NextGen as a director on the company before death, as that could also reduce some stress during the probate process. These are all things that might not be considered by XGen, and sometimes as the younger generation we assume, our parents have it all figured out, and parents typically don't want to hear advice from the next gen. But there's definitely a large opportunity for next gen to try to meaningfully engage that conversation from a point of heart, and actually caring for their family. Because if so much time and energy has been spent on building something, why would the family not want to keep more of that around? Because I know in this situation, if we didn't do the planning, there most likely would have needed to be an asset sale, whether it be real estate or whether it be some or all of the business. So life insurance couldn't be used in this situation because XGen is too old, but if you do the planning well enough in advance, you can even use certain products to pay off taxes, pay off probate, and ultimately give control to NextGen without being in a situation sell assets in order to close off the estate.
What are some of those products? So pretty much like those are so that you don't pay the probate fee.
Yeah, so a simpler one for a simple estate might just be a segregated fund. This is like a mutual fund or an ETF, but you can actually add a beneficiary designation. This ultimately allows the beneficiaries and the current holders to avoid creditors coming after those assets, and it will not be part of the public registry, because let's not forget, any assets that flow through probate will be publicly available for a simple $6 probate search. Some other assets, like I mentioned, life insurance could be good. You got to qualify medically, so not necessarily useful in every situation, but there's a lot of tax benefits to that. If the life insurance policy pays to the corporation, that's going to create a capital dividend account, which allows a large portion of that death benefit to be paid tax-free out to beneficiaries or directors of the company. So those are a few: seg funds, life insurance, and then there's plenty of legal structures, alter ego trusts, family trusts. Not all families want to engage in that depth of planning, but depending on the size of the estate, it might be worthwhile to at least evaluate any of these structures.